Order, order. Welcome to the Treasury Select Committee on Wednesday, the 7th of May, 2025. Today we are looking at AI in financial services. AI is the solution to everything, as the government seems to be telling us, but obviously there's huge implications in financial services, and we're in our first session really on this as our first foray as a committee into how this might affect businesses, consumers and the financial sector more generally. I'm delighted to welcome Jana Mackintosh, who in the middle here today, who's Managing Director for Payments and Innovation at UK Finance. Welcome to you. David Otudeko, who's the Director of Regulation at the Association of British Insurers. Welcome. And Amandeep, who's the Artificial Intelligence Lead at the Association of Financial Markets in Europe, sometimes referred to as AFME. So, very warm welcome to you too, Amandeep. And I'm going to ask Chris Coughlin MP to kick off. Mr. Coughlin.
Thank you, Chair. Thanks so much for coming in this afternoon. We're all very worried about the UK productivity crisis in particular. So, Ms. Mackintosh, how confident are you that AI will boost productivity of financial services?
Thank you very much, Chris, for the question. Good afternoon, everyone. I think there's a lot of evidence from the years of consideration, exploration, pilots, and now kind of early adoption of AI that we've seen that can lead us to feel quite confident about saying we think there will be a positive impact on productivity. Some of the kind of recent estimates have shown that productivity can be improved up to 30%.
In financial services?
In financial services. It very much depends on the use case and on the organisation and the application thereof within that context, but I think we can be quite positive about that.
Do you know how long they're likely to take to materialise those productivity gains?
The productivity gains in terms of 30% that I'm talking about are for the use cases that we've already seen being implemented. If you see scale adoption and great kind of use of the technology, you may very well kind of see that gradually increase in terms of its breadth, but also potentially in terms of its impact.
Should we expect generative AI to be a major step change on that?
It certainly has had a significant impact. I think we've kind of seen predictive AI being adopted earlier. We've been exploring that for longer. Generative AI is maybe a little bit more nascent in its application. So as we progress with that, most certainly, yes. And
are you expecting any sort of particular breakthroughs, or is it hard to presumably it's quite hard to forecast?
It's a little bit hard to forecast. With all technologies, I think we always consider whether there will be some form of kind of breakthrough use case that will kind of like force kind of mass adoption or scale. At this point in time, what we're seeing is a gradual adoption of the technology. As we become more comfortable with understanding the technology, understanding the risk and implementing it, over the 10 years that we have been looking at this, it has been gradual. So I think you can assume that there may very well be an uptake, but yes.
Thank you. And Mr. Otudeko, there's a very high percentage of firms using AI in the insurance sector, apparently 95% according to the Bank of England. Could you explain what makes the insurance sector so well placed to adopt it?
I'm happy to, and hi everyone. So I think first of all, we're an innovative sector who embrace technology, and we're also very data-centric. And I think that's really the opportunity that AI presents in terms of, how we interrogate and we use AI to structure data and to obviously drive insights from data. Just to Jana's point about generative AI versus predictive AI, I'd say the insurance and long-term savings industry have been using predictive AI and advanced models of that description for quite a while, and it's primarily been focused on, as I say, data analysis and trying to drive trends. So when we're talking about generative AI, for me, it is a bit of a step change in terms of, the adoption of it and actually trying to understand the risks before you go headlong into adopting generative AI. So the 95% figure is focused really on, existing sort of technology that we're aware of.
And presuming it's at the point where you can probably no longer be competitive in the insurance sector unless you use AI?
It will be a factor, but I can't hand on heart say it would be the only determinant of competitiveness in the sector, whether locally or internationally.
Okay. And we've also received evidence that fintech firms are quicker to adopt compared to traditional firms because they're more agile. They've got fewer legacy systems and they've got a culture of innovation. Would you agree with that in your experience?
Would, but fundamentally, the business model of a fintech hinges on the use of technology, so I'd expect them to use technology considerably more than, I suppose, your traditional insurers. But the 95% adoption figure in the sector proves that clearly is a sector that's looking to innovate, but looking to use AI safely. And as I mentioned earlier, before sort of going into it, making sure we understand the risks fully before we adopt, which is what we're seeing in terms of the generative AI space and the sort of gradual approach to its adoption in the insurance industry.
Thank you very much.
Thank you very much, Mr. Coughlin. Jean Sandra.
Thank you, Chair. Mr. Luther, I want to talk to you about the ways in which AI may change employment within the financial services sector. I think it's been around the kind of tasks that may be, if you like, carried out. What tasks do you see in the financial services sector being, I was going to say automated, but that's a little bit old, done by generative AI or any kind of AI in the future?
Firstly, thanks for the question, and probably I'll take a moment, if I may, just to give some context to some of the answers that I give today. So I am the AI lead at AFME. So AFME, as the Chair mentioned, is the Association of Financial Markets in Europe. So our members are the largest global and regional banks who have a presence in the UK or Europe. So collectively, we encompass approximately 90% of European issued debt and 80% of European issued equity. So I guess I come with it from that lens. Our work primarily focuses on advocating for the adoption of AI within financial services. And within that, we speak with both regulators, governments, as well as large and small tech firms to help banks get the information that they need in order to move forward with the technology. Going more directly to your question, I think it's important to make a distinction, as we have already to an extent already, on what we mean by AI. So AI, typically nowadays in the conversation, tends to refer to generative AI, which is really the technology which has only really been in existence for the last 2.5 years, and it's pretty nascent. But in terms of where AI adoption is with banks and how it's changing and how it may change employment and skills in the future, I think we have to kind of look at it in the round, right? So generative AI is more of an iterative technology. It had a breakthrough moment to the public perhaps 2.5 years ago, but in terms of how banks have been using it, it has been around in various guises for a while. And so what that means is that it's not quite perhaps the step change in the wholesale market as it may appear to be perhaps to the general public. So from a skills and an employment perspective, we have seen that gradual upskilling amongst our workforce for the last decade or so to incorporate technology such as this. And while there is certainly elements of the new technology which does require perhaps external skills to be brought in or further upskilling, we're still not seeing a dramatic shift there. So in terms of the employment profile or the staffing profile in the wholesale markets, at this point in time, we're not seeing a dramatic shift which we can really attribute directly to AI. I think it's fair to say, though, if we look forward the next kind of 2 to 5 years, we would imagine that we'd start to see perhaps a change in the level of skills that are in demand, and I can imagine that certain roles may change. But at this point in time, it's difficult to see a radical change to the staffing profile in the wholesale markets.
And then looking forward then, to terms of having new skill creation, do you think, or the new task creation from AI that you're able to do, do you think that new task creation is going to outweigh some of the, if you like, the older tasks that would no longer be done because AI is now helping to perform those?
Good question. I think it's hard to quantify whether it will outweigh existing tasks. And if I may clarify, is your question referring to, are there certain types of roles or certain types of skills which may become obsolete in light of the new technologies? Is that what you're referring to?
Yeah, so I think, if you think about like the automation revolution, like people had computers and they could do different things. So you didn't have to sit there with a slide rule, like Excel does it really, really fast. Yeah. Now it meant that jobs changed, but jobs weren't destroyed because people became more productive. What happened in the middle lane market was slightly different. So the question I'm really getting to is, are there enough new tasks being created inside the industry going forward that you see? Or is it actually that AI is going to do so much and there won't be that much for demand that actually the employment will fall in the sector has happened, I don't know, like farming like 200 years ago, for example?
I think in the wholesale market sector, in the wholesale market's perspective, I would not expect to see that dramatic shift that you're describing there. I think we have a history as an industry of incorporating new technology in a gradual process. So there's been a gradual electronification of markets over the course of the last 20 or 30 years, and AI is probably just a natural evolution in that process. So there are certainly roles that we're seeing already today and activities which are being performed by staff, typically the more procedural and more repetitive tasks, where AI and generative AI has certainly made things quicker and easier. But for the most part at the moment, what we're seeing is that has freed up staff to work on more value-added tasks, as opposed to making that role redundant in its entirety. Now, again, it's important to clarify that Gen AI in particular is very, very nascent, and the advancement is extremely rapid, probably in a way that we haven't seen technology advance in recent times. So it's very difficult to make a prediction, perhaps several years out. But at this point in time, from a wholesale markets perspective, we're certainly seeing it as something which augments our existing workforce, as opposed to changing fundamentally the roles and responsibilities within organizations.
And when it comes to this new task and the skills required for it, how are you finding the training, if you like, to help your employees? And on the other side, how do you feel government is working with you to help create those skills?
I'll take each of them in turn. So in terms of how our members are looking to upskill their employees, there's two elements to it again. There is an element where this technology is moving at such a rapid pace that the knowledge and skills is really being developed outside banks to many extents. And so where that is the case, our members are working as hard as they can to ensure that they can attract those individuals with that knowledge to work into the sector, to enable us to inherit some of that knowledge and pervade that throughout the organizations that we work with. But that doesn't take away from the existing employees that we have already in the organization. And that domain knowledge is extremely valuable. And so to that end, our members are engaging very actively in upskilling existing members of staff. And again, this can take different angles. So there are some staff who may just need a general awareness of the technology, what the limitations are, how it can be used, etc. And there's one level of training which most firms are now rolling out almost across the board to all employees. There are other employees who may be involved in actually developing these tools, and for them more technical training is being provided, either both internally or via external certifications, etc. That certainly is an active area, and we've definitely seen an uptick in terms of both hiring into the sector, so in terms of job creation in the wholesale market sector from AI in the last couple of years, and we're definitely seeing an increase in the training that we're providing of a more technical nature, which perhaps 5 or 6 years ago we may not have been doing. In terms of the government support in supporting firms to I guess engage in that upskilling, at this point I think it's fair to say that it's not something that has required us to take significant government support on. That support is there, I feel, when we need it in conversations such as these. But at this point in time, the conversations are at a reasonably technical nature, such that there are providers out there and skills out there that we can adopt within firms.
I think my final question, which is around graduates and non-graduates. So, like, non-graduates have lost out a lot over the past 40 years. Manufacturing disappeared. It was done by machines that benefited by people who, I suppose, sat in this room going forward, but obviously non-graduates lost out. About a third of those in financial services are non-graduates, and they're going to need either up-training or will end up leaving the sector altogether. How do you think we should ensure that non-graduates can remain engaged inside the sector as it changes with AI?
That's a great question. I think AI is very unique. It's a very unique technology, and Gen AI specifically, in that it is very general in its nature and very general in its application. And while you're right to point out that graduates may be in a good position to capitalize from AI, I think that's really more in the much more technical areas where perhaps the graduates are involved in engineering and data science and maths, where their knowledge would be very applicable to developing some of these models. But what's unique about AI is that these models, being generally applicable, can be used by somebody who's very, very non-technical. And that actually has become quite key to the wide adoption of the technology. So, for example, I'll give you an example that a lot of our member firms have seen in software engineering. So software engineering historically been a very, very technical profession, typically involving somebody who had to have a degree at a minimum, potentially even postgraduate degrees, knowledge of maths and science and so on. But with some of the newer AI technologies, anybody with very, very little, in fact, to some extent, no technical knowledge can actually start to build software. So we've now started to see quite a new world, which would have been unimaginable 5 or 6 years ago, where somebody with no technical knowledge can now start to specify to some extent how they want software to behave, which kind of works for their personal use. So I think that we are seeing that quite unique situation here, where both the graduates and the non-graduates can benefit from this technology. And again, in terms of going back to your original point about job creation, I think I would really fall back to my previous answer. We're still not seeing amongst our members a significant shift in the roles and responsibilities within firms. But we are seeing that adoption of AI across the board, and I think it benefits all employees, whether graduate or non-graduate.
Thank you. Thank you, Chair.
Thank you very much, Dr. Sander.
Yes, Mr. Luther, could I turn to the culture of the workplace and how AI might impact it? There's been some evidence that suggests that AI is capable of looking at things like harassment, bullying, and I imagine probably performance issues generally. And I wonder what you think about the extent of the scope, really, of the impact of AI on behaviours, and what you think is likely to evolve in that area.
Sure. So I think the first thing to point out really is that the monitoring and surveillance of employees in the wholesale market specifically is a regulatory requirement. So trading in particular is one of the most tightly regulated areas of financial markets. So we have surveillance in place by regulation to detect areas such as market abuse, misconduct, etc.
That's transaction related. I'm talking about the sort of stress levels and the sort of well-being issues.
So again, there's probably two elements to that. So yes, there's transaction surveillance. There's also surveillance around communications of such like. But when it comes to almost the emotional surveillance that I think you're getting at here, so detecting someone's behavioural patterns, it actually is an area that your clerk had mentioned may come up in the hearing today. So I canvassed several of our member banks a couple of days ago to ask them about this very point. And none of the wholesale banks that I spoke to reported using technology of that nature. There's a very clear set of guidelines around how any kind of monitoring or surveillance can be put into place. And they're very clear privacy controls and privacy committees that have to be satisfied before any technology is put into place. This technology is generally ring-fenced around business platforms, business hardware, and business activities. And at this point in time, none of our firms that we work with are either using any kind of emotional detection using AI or have any plans to implement surveillance of that nature.
And I guess there are some applications for people who aren't in the workplace at the moment, people with disabilities, perhaps people who are partially sighted, using text-to-speech and so on. Do you see any scope or evidence from your members that this is an area where they are considering new options for recruitment?
That particular scenario, I've not seen any evidence of, but if I may give an opinion on that to the extent that I'm able to. We certainly have seen, again with generative AI, as I mentioned earlier to your colleague, that AI is enabling individuals with different skills to perform roles that they were not able to before. So, and it certainly is the case that AI, generative AI, text-to-speech technology is coming on in leaps and bounds. And so, to the extent to which that enables individuals who may have not been able to perform a role before, but are able to now, as a result of the technology, our members would certainly be willing to explore that. And it's something that, from an employment and recruitment point of view, it's something that we're always open to. So, I see no reason why anybody would be held back from working in financial services because of a disability like that. Certainly, where AI could help.
What about the other witnesses?
Yeah, happy to give a view. I think I'm proud of my industry and our diversity credentials and the fact that we take diversity, equity and inclusion very seriously. So I'd see members jumping at the chance to actually, give people who are qualified to do jobs the opportunity to do those jobs and not stopping them from seizing those opportunities because of disabilities or anything else, that might be listed under the Equalities Act. So it's definitely something I'd say my industry will jump at the chance of adopting if the opportunities and the use cases do present themselves.
Jana Mackintosh?
Thank you. If I may add, I think we don't kind of see, when it comes to recruitment, emotional monitoring, emotional manipulation, those are very high risk applications and use cases when it comes to AI. And from the work...
You mean it's not a reliable tool to be using to monitor and evaluate people in that regard?
Yes, I mean it's not well understood enough or developed enough for us to kind of feel certain that there aren't any risks associated with kind of deploying that comfortably and confidently. So we don't see those, certainly in the use cases that we've explored across kind of banking and payments, that those are being used as use cases where the technology and the adoption have been focused on predominantly as either well understood areas like risk management and fraud detection, or kind of like emerging areas where there are low risk use cases with kind of human monitoring over those use cases. So I think some of the use cases that you're talking about, we certainly have not seen being adopted in that same sense. But related to that, in terms of understanding vulnerable customers, we do now comply with the consumer duty that have been implemented, and so there is an obligation on the financial services firms to make sure that they understand their customers. I think AI can be a useful tool in helping make sure that we better understand customers, but managing the risks in terms of keeping that kind of data and information kind of private and confidential, and it being used in the right way. So that is an area in which it can be helpful, but it can also be helpful to vulnerable customers in terms of the enhanced products and services that they can potentially receive through the use of the application of AI.
But isn't there a risk that the profiling that you can now do, both of your customers and your potential recruits, notwithstanding the obligations of the consumer duty, is going to be a huge temptation for large organisations to say, well, actually, we don't want people with these characteristics, and they can be sort of screened out without anyone knowing about it. How do we give confidence that you won't be doing that, or not you, but generally the industry won't be? And then on the issue of consumers, of course, the cost to serve across a whole range of customers can be quite a significant range. There must be an enormous temptation to say, well, actually, we know people with this profile, this characteristics, this history will be more difficult, so we can prioritise them differently. How do you not recognise that risk?
I suppose in thinking through your question, like many of the risks that you encounter when you think about the adoption of technology, and in particular in AI, many of the risks are not new. But I think the application of AI can certainly kind of amplify those in the way that you're talking about. For the same reasons that we feel, as Mr. Otudeko kind of said, confident that the industry is acting in the best interest of kind of the employees that they bring forward and their customers. Applying a technology tool like AI should not change that risk culture, that kind of behaviour that you would kind of expect within the organisation. There may be kind of greater temptations, but within the risk frameworks that you will employ to recruit, to kind of manage employees, the tool itself as a technology should not really change the culture and behaviour of an organisation.
I must just press you one more time on that. I mean, it shouldn't, but we also know it clearly could, and to gain competitive advantage in what can be a very intensely competitive industry in parts. What proactive safeguards or assessments or studies or work needs to be done to ensure that this doesn't emerge before you have to do it after there's some sort of crisis or scandal blows up when a whistleblower tells us?
Yes. Well, I think it's right to kind of make sure that we understand and kind of manage some of these kind of more extreme high-risk cases in the right way. There are ongoing kind of like conversations with regulators in terms of the compliance under consumer duty or other regulations that would be applied in the same way. So hopefully you'd be able to kind of monitor and detect some of those kind of risks as they emerge, not after the fact. You can also kind of be quite proactive if we think about the way that the regulations have evolved in Europe. They've prohibited some of these use cases, and so if as an economy, as regulators, as a society, we feel that some of the technology shouldn't apply to certain use cases, you can go to the extreme and make sure that the regulatory framework or the kind of way that we look at kind of working with regulators consider those use cases, and especially those high-risk use cases, up front.
Okay.
Thank you very much, Mr. Glenn. Lola McAvoy, MP.
Thank you, Chair. We're going to move on to algorithmic trading and generative AI, and I thought we could start off with you, Mr. Otudeko, about where you put yourself in terms of being a skeptic or a zealot for the adoption of more algorithmic trading and more bots trading on our markets.
Thank you for the question. I'm giggling because I read the evidence given by Mr. Woods and Tanya Castell, and I thought to myself, I'm definitely going to steal Tanya's response. I put myself at both ends if I can, because as I said at the very beginning, my industry is very pro-innovation, and we can clearly see the opportunities that AI presents, and we really want to embrace that, not just for the benefit of our business models, but also for the benefit of our employees and the benefit of our policyholders. But I'm also a risk person, and I'm alive to the fact that you need to monitor the risks specifically of technologies that are emerging, and for something like AI that evolves very, very quickly, it really requires you to be on your toes in terms of how quickly you can identify those risks and how you mitigate them. So for me, you almost have to keep your eyes on both ends of the spectrum. So I'd say I'm both ends. It's a classic sitting on the fence answer, but it generally reflects what I think about the topic of AI.
And with AI, particularly generative AI, in our trading markets and the future of sort of more bot trading, what's your analysis of the risk versus opportunities that brings?
Probably not one that sits squarely for an insurer. But again, it's really about the point I made at the beginning about a gradual adoption of generative AI is really so you can understand the risks before you take the thing on, because you don't want really to be addressing the issues after the fact. You want to understand them before you implement these technologies. There are a lot of elements across the insurers' business models around things like investments, slightly off topic, where you have to understand the end-to-end risks before you actually place investments. And I'd almost go as far as saying with things like technology, AI, you have to feel comfortable that you understand the risks before you adopt those technologies. So again, it's about risk management and just balancing the opportunity versus the risk presented by the technology.
Okay, thank you. And Jana Mackintosh, so in your analysis, are you a zealot or are you a skeptic of specifically algorithmic trading and the use of AI in that?
Well, again, I'd say that when it comes to statistical techniques being used in trading, those are very well known and have been used for a very long time. There will naturally be an evolution of some of those algorithms within kind of trading, and technology will aid those. They are being explored, which I think is rightfully so, but would agree adoption comes with all the other kind of like measures, considerations, risk management that will have to kind of like be built into it. There are certainly kind of more complex machine learning techniques with the kind of combination of kind of human oversight will benefit and kind of provide benefits to the sector and to kind of trading.
Sure, on that, like what? What benefits to the sector would we get?
You do get kind of efficiencies in terms of transactions, speed, intelligence gathering, the way that you kind of like inform decision making, risk management, that kind of comes with that. This is all information that you can kind of gain by employing AI. AI generally, when it comes to some of these use cases that have already embedded some form of machine learning or statistical techniques, the benefit of AI just means that you can potentially perform a task faster and kind of with more accuracy.
Okay, so there's machine learning, but then there's specifically bot trading, replacing, to go to Dr. Sanders' point, replacing existing jobs with AI-generated traders. And I think we're all up to speed with the benefits of productivity and in some of the back office sort of processes, but in terms of actually taking those transactions, there are some serious risks. And do you think we've got the regulatory framework right in this country to mitigate against them?
I think at the moment we don't see those being employed. We don't see that being kind of like used. It is an ongoing area of research with the Bank of England, and we are supporting them and kind of making sure that we can consider that before any kind of financial services firms will consider deploying those.
Okay, so they're not being used in this country at the moment.
Not as far as I'm aware.
So I was going to say, Mr. Luther, coming to you because I think you might have something you wanted to add on this. Would you, first of all, where do you put yourself, sceptic or zealot?
I think it would be hard for me to claim I'm a skeptic, given that I advocate for the use of AI in financial services, and AI is actively being used in trading today. I think what I'd say that it's important initially to probably clarify what we mean by algo trading and what we mean by AI, because often I find that the two can be conflated in conversations such as this. So algo trading has been around for decades, right? So in the late 80s and early 90s, we had computerized order books. So the ability for you to leave an order at the exchange to be executed without any human involvement whatsoever. And that's been around for a long time. And as technology has developed outside of our sector over the last 20 or 30 years, the sector has continued to adopt that technology and move along that journey. So what that means is that machine learning, traditional machine learning, so the non-generative AI variant, has been in use in algo trading for the last decade, certainly, potentially even up to the last 2 decades.
So just for clarity on that point, that's where somebody is operating it, but are using a machine for efficiency, and to make it quicker, and just basically using a computer to trade.
Not exactly. I'll give some context. So, as computer technology has improved, and that's both hardware and software, it has enabled more and more inputs to be provided into a trading decision, right? So in the world before computerized trading, a human being would take inputs from reading the news, watching what's happening in the world, stuff that they're hearing, and would take a decision on whether they wanted to buy, sell, hold, etc. As computer technology has improved, we've been able to add additional data points into that computation process. What AI enabled the sector to do a decade ago is to introduce new data points that we perhaps weren't able to use before, or to analyze that data in a much more accurate way. That does not necessarily mean that there's a human kind of operating the machine, if you like, but the human writes the code for the machine, tests the code for the machine, makes sure that that code does what it says it should and what we intended to do, and that enables that data to be analyzed pre-trade. But that's the key thing there. So this technology has been historically used pre-trade. It has not been used in the decision-making process when it comes to deciding whether to trade or not. That still is a very deterministic decision. And I'll give some clarity to my answer there. So as I'm sure this committee is very well aware, trading is one of the most highly regulated and highly controlled areas of banking, right? So we have regulation in place for almost every element of every second of your day on the trading floor. And if I give an example, if you go back just under a decade ago, a new regulation called MiFID II came into place. And MiFID II had a whole bunch of regulations, one of which was around algorithmic trading. And there was a very clear set of rules of what firms had to do in order to engage in algorithmic trading. And I'll read you a couple of them just for context. So there's rules around governance frameworks, there's rules around senior management oversight and accountability, pre-deployment testing, live monitoring while the algorithm is running, alerts that are generated, kill switches, circuit breakers, such that if certain scenarios arose, the system would switch off or refer back to a human being. And these all serve to effectively create almost a perimeter around the arena of trading. Any activity which happens within that arena has to conform with those regulations in order to cross over that perimeter, whether that decision is taken by a machine or by a human being. So when it comes to the use of AI in algorithmic trading, that same threshold has to be crossed. So as traditional AI has been used in the past, as Gen AI is starting to be used and may be used in the future, you cannot put that system live without satisfying the regulations to cross over that threshold into that arena.
So can I take, from what you've said then, you think we have got enough regulation to be able to move with the technological advances in this space? You said about where certain scenarios arise, there's a kill switch. What sort of scenarios are we talking? Can you speculate with the introduction of more robot traders what that would mean?
Again, I'd probably just to clarify the terminology again, when we're talking about robot traders, certainly in the wholesale financial markets, again, at this stage, that is still pre-trade activity. So the robot trader in your description there, in the way the technology is currently being used and is planned to be used in the near future, is not going to be making trading decisions in and of itself without any human supervision. That is something where the technology is not quite at the level required in order to be deployed in that manner. Certainly, it allows us to use the generative AI technology, allows us to perhaps incorporate data sources which we were not able to use before, or able to analyze it in a way that we were not able to do before, just because it has a much greater understanding of text-based data than it did before. But in terms of, I guess, the overall frameworks, the frameworks are technology agnostic. So as technology evolves, it's incumbent on organizations to ensure that they can meet those regulations in order to deploy that technology.
Okay, that's interesting. Sorry, final.
One last one.
Sorry. I just really,
now,
really
I'll
interested in this
bring it back
subject. Sorry. In a recent speech, member of the Financial Policy Committee, Jonathan Hall, expressed concern that AI trading models could be incentivised to amplify shocks because of where they get their source material from. Do we have enough regulation in this country to protect against that? And what's your analysis of how big a risk that is for us in the UK?
Sure, and that actually probably ties into the second half of your question, which I didn't answer in your previous question, around kill switches and circuit breakers. So the short answer is yes. The regulation as it currently stands, in terms of how our members operate, we would deem sufficient as it currently works, given that it is technology agnostic. And the reason it works is that, as I mentioned earlier, in regulations such as MiFID II and certain other regulations around model risk and how we ensure that the models which are being deployed by our members conform and do what they're meant to do. Part of that involves defining scenarios under which that system would either alert a user and carry on running, or would switch off entirely and require the user to take over. So these could be scenarios such as where a piece of information is incorporated by the model, and the system has determined that a certain course of action needs to be followed, whether that's buy, sell, hold, whatever quantity, etc. But there are threshold controls within that process which operate constantly on a real-time basis to monitor those movements. So, for example, a stock exchange would have a control around the extent to which a price can move within a certain time period. So if that price moves too quickly in that certain time and meets that threshold, the circuit breaker will be triggered. Circuit breaker essentially means that security can now no longer be traded. And the theory behind that is it allows the market to cool down, to assimilate the data, and when that trading can be resumed in that security, things would likely to be in a calmer fashion. So these controls exist both on the exchange level, but they also exist at individual firm levels as well. So that entire system is designed to work together to try and dampen and reduce the effects of any kind of scenarios where potentially your trading could move in one direction very rapidly.
Thank you for now, Mr. Luther.
Yeah.
Dame Harriet Baldwin,
If
MP.
I may very quickly, Chair, a question for Jana and your members. We've heard in the past from policymakers about their concerns of the quantum apocalypse, when quantum computing is used to basically unencrypt everything and causes a massive systemic risk to the financial system. And I just wondered if your members believe that artificial intelligence is a power for them to prevent that from happening, or something that actually increases the risk of that happening.
Jana Mackintosh.
Just a quick one.
Quick one. Again, like AI, we have been exploring kind of quantum for quite a while, so the kind of risk of quantum graphic vulnerabilities are very well known. We've considered that for a while. There are actually kind of quantum safe technologies or post-quantum technologies that you can employ to kind of protect yourself from kind of that risk going forward. So firms have been looking at their own vulnerabilities.
We shouldn't have to worry about it at all then.
There are, of course, kind of interactions with AI where, again, similarly, kind of the application of the technology can speed up processes. And so we would need to kind of be aware of that risk and the combination between AI and quantum, but the underlying fundamental risks remain the same.
Okay.
Thank you very much indeed. John Grady, MP.
Yeah, thank you very much, Dame Meg. Need to keep this plugging along, so keep answers short. My first question really is...
On this huge subject.
Huge subject. First question perhaps to Mr. Luther. Do firms understand the counterparty risk of AI providers? And by that, I don't just mean solvency. I mean, do these counterparties have idiosyncratic risks, such as the departure of a core team would be very damaging to ongoing provision of the product?
So I guess, again, I'll answer your question in 2 points. Firstly, around do we have a handle on, does the sector have a handle on those firms? And secondly, how do we reassure ourselves of that fact? The answer to the first part, not surprising, would be yes, we do deem that our members have a very strong handle on the third-party providers. But the reason being for that is, again, from a technology point of view, irrespective of the technology provider, whether AI or otherwise, there are very strict regulations around the use of any kind of third-party technology vendor. And that involves significant due diligence on that vendor, significant contractual arrangements in place with the vendor to ensure elements such as transparency around data, transparency on how models are trained, transparency around their operation, their hiring processes, their solvency to an extent as well. And these are contractually bound terms. To your point around, could a departure of a core team in a vendor jeopardize the operation within the bank? Again, that is a core part of that process. So the resiliency of the vendors is, again, a very core part of that due diligence process that's undertaken before engaging with any vendor. And again, that process also has a contextual element to it. So if you're using a vendor for a very small, minor part of the business, that tolerance may be lower than perhaps if you're using that vendor for a very critical part, a very critical, serious part of the business, in which case you would take a very different view of it.
And then just very quickly, Mr. Mackintosh and Mr. Otudeko, is that similar from your perspectives? Reflect your understanding?
Yeah, certainly so. I think when it comes to third-party management and especially kind of critical third parties, there's a lot of ongoing work within the sector for us to kind of make sure that we understand that the contractual kind of relationships will, fully embed and consider the risks associated with the introduction of new technology. And so, yes, do agree with that. It does extend across kind of other critical third parties and third-party suppliers you contract with.
So I completely agree. Again, Mr. Woods mentioned the critical third parties regime that the regulators have recently introduced. They've also recently introduced operational resilience requirements more broadly that would cover third parties. There have been long-standing requirements around outsourcing and the need to conduct due diligence, as colleagues have mentioned, on third parties in the sector. I think it's important to highlight that whilst we all think that the current regulatory environment works for the risks of now, that is no substitute for vigilance. And proper risk management within firms in terms of their ability to identify risks as they evolve and have emerging risk frameworks so they can see things coming down the track before they actually hit remain critical. So it might be all fine now, but that is no substitute for maintaining vigilance on
Can I just
AI
ask,
as it evolves.
are risk officers in banks capable, or financial institutions capable of monitoring this risk? And that doesn't sound not being rude about them, but it's a very different set of skill set.
No, it really is. The way I think about it is your traditional risk management process does not change off of the back of AI risks. The elements of the process that are altered are how you identify those risks and how you mitigate those risks. And for those two elements within the process, you need specific skills to refresh your skills on a very regular basis to be able to identify those risks appropriately, and also to be able to identify the appropriate mitigants, which will be a combination of technical knowledge, someone who knows the IT and knows AI very well is able to let you know about, versus actually someone who knows the business very well and the applicability of those mitigants within the business. So I'd say those two elements of the risk management process is important to get really, really right. But to your point, it's important also to make sure that you have the right skills to be able to identify those risks. And for that, you need to constantly look at your skills base within any organization. But fundamentally, I don't think the risk management process changes. And that gives me a little bit of comfort in terms of we're not having to come up with a fundamentally different process on how we manage risks generally.
And when it comes to risks, they ultimately sit with the board of directors and the senior managers of the firm.
Yes, they do.
They're the ones who are legally liable and responsible. But a lot of these models are effectively, are they not, black boxes and very complicated. So how confident are you that the directors and senior managers of the insurance firms in the UK, for example, really understand the limitations of the models and the risks involved, such as opaque decision making and hallucinations?
So I think that there's three elements to that. I think first of all, and I don't think anyone's mentioned the senior managers and certification regime so far, there is individual accountability and responsibility on certain individuals within a firm's leadership to be able to identify and manage these risks properly. And I'm talking about the SMF4, the Chief Risk Officer. It's essentially on their head if they don't do it properly. So they have quite a big incentive to make sure that they understand these risks before they go head on into adopting AI. And what was the second part of the question?
How confident are you that boards and senior managers, boards in particular, directors, in firms understand this stuff?
And so it was about the explainability and the fact that some of these models are quite opaque. So this really does, again, speak to regulation around model risk management that the Prudential Regulation Authority is introducing for banks, and has also pointed to the insurance sector in terms of, again, before you adopt these technologies, you need to understand how they work.
I know, and you're answering the question sort of, but gently. I guess the question is, at present, pending the PRA's work, do directors and senior managers understand what they're using in this very advancing, complex technological world? And I'm humbled enough to say that I do not fully understand all this stuff. So do the directors understand it, would you say?
I'd confidently say that for technology that's been adopted now, yes. For technology that's emerging, such as Gen AI, that probably then points to the reason why firms are taking a softly approach to adopting it, because you need to learn and understand the risk fully and be able to back that to quite a few different stakeholders before you adopt such technologies. But again, I'm not going to sit here and go, it's a one and done when it comes to learning about technology. You need to constantly refresh your knowledge and sort of bring it up to a place where it's in keeping with, the technology of the day. So I'd say yes.
And then the other question I'd ask is on the outputs from these models, which is coming back to a theme that Mr. Glenn picked up on. So if I'm looking for insurance, how is the industry doing at testing the outputs of these models to ensure that they're giving fair and justifiable answers? So, for example, the insurance premium for someone with a mental health condition is reasonable and sensible. So how does the industry go about testing the outputs of these models to see that it is giving rise to outputs that are consistent with the consumer duty?
Two things I'd say. So we've talked about AI, but we've seldom mentioned the fact that you're not going to get rid of human beings in the channel in terms of checking the outputs of these models, right? So there will always be a human being at some point checking what a model actually gives as an output. And secondly, I know I mentioned this earlier, but back to model risk management. Look, historically in the insurance sector, perhaps we thought about model risk, particularly in the context of capital models, et cetera, but actually these are now very, very applicable and live when it comes to AI models. And there's an element of good model risk management around model validation, which is you fundamentally checking the outputs of the model. So if you have a good model risk management policy, validation of the outputs of the model is a key element of that. And that really speaks to your point in terms of
And if I wrote to the top 20 insurers in Britain and said, please could you provide confidentially, because it would be confidential, your model risk management policy, would each of those policies pass muster in those?
I'd hope to God they would, because Sam Woods wrote to the CEOs of the insurance sector in his 2024 business plan saying exactly that. You need to pay attention to what we've asked banks to do on the model risk management side and essentially get your houses in order. So I would hope that they would, yes.
That's enough from me, Dame Meg. Thank you very much. Thank you, Mr. Wood.
Thank you, Mr. Grady. Liv McAvoy, MP.
Thank you, Chair. So just to follow on very quickly on that point, because the Chair's going to tell me off. So there is it could be that if there's a load of AI firms watching this, they're like, we could have robot traders, we could have more technology, but at the moment we don't have anyone to translate it to the people who'd be responsible for taking the risk on behalf of the consumers. So that means, in a nutshell, as far as I'm concerned, for constituents in Darlington, the regulation's working well. Yeah? Would you agree with that?
I'd go as far as saying that. I'd say don't take on technology you don't understand. So, yeah.
Great.
Okay, you're nodding as well?
Yeah. Yes. Great. Okay. Just checking. So, cybersecurity, another fun topic for us to dip our toes in. So maybe for Ms. Mackintosh, how much has AI boosted the ability and capacity of cyber criminals, do you think?
Well, the technology is available as much to us to benefit from and use as it is to kind of those who want to kind of use it in the wrong way. Within kind of cybersecurity and operational risk management, again, when it comes to financial services, we have really great frameworks in place and regulations to kind of help us think that through, especially over the last kind of 5 years. And having a big focus on operational resilience with the new operational resilience policies that came into place this year. firms have kind of taken additional steps to kind of make sure that they understand the processes, the vulnerabilities, the impact it will have on their businesses and their consumers, and kind of put mitigants in place to kind of address those. The introduction of AI, again, kind of amplify some of those risks that you could think about. If you think about kind of like cybersecurity in particular in this context, there are probably a couple of different angles to consider. One is the vulnerabilities introduced into the banking sectors when we use AI and the kind of systems that those are embedded in, and like any other kind of operational matters, making sure that those can be safe and secure alongside the kind of provision of services across the bank. So not making sure that we introduce those vulnerabilities when we adopt the technologies when it comes to cyber is really important. So that's one area. The second area is around kind of like being able to kind of deploy the technology in a proactive, offensive way to kind of make sure that you can have greater information and threat intelligence available to kind of defend against kind of like those threats kind of coming in. Because, as you kind of rightly say, I think the same technologies will be available to those that kind of would want to use it in the wrong way.
So we could be using AI, be using this new technology to actually protect ourselves against cybersecurity, the increased cybersecurity attacks from AI in the first place. That's interesting. Okay, and do you want to just tell us a few more scenarios for a bit of colour for the committee? What sort of vulnerabilities are we talking? Give us some scenarios of where this could be, where we could be at a greater risk from cybersecurity threats.
Well, the use of AI does rely on big amount of data. So storing that data, using that data within systems, kind of like does make it attractive to criminals wanting to kind of extract that data and potentially use it in different ways. So the vulnerability in terms of that kind of information security is really important when it comes to the introduction of AI into those kind of systems to make sure that they adhere to the same level of scrutiny and security that is needed. You could also vulnerabilities in systems when it comes to kind of AI be in terms of the kind of introduction of new products and services where you may not have kind of like necessarily yet had the same level of kind of market experience, and so kind of how criminals will use that to kind of enter the systems to kind of like exploit new products and services or offerings that would increase fraud or risk within the system is really important to kind of like understand as well. Those are two examples that I'll give.
Thank you. And Mr. Luther, did you have anything you wanted to add on that point? Cybersecurity, sort of what effects do you think you can envisage Gen AI specifically having on cybersecurity threats?
Again, there's probably the two sides to it. One is, I think it unquestionably AI makes it easier for bad actors to perform their role, but AI also makes it significantly, certainly gives advantages in combating those challenges as well. So AI is both the perpetrator as well as the solution to some extent. What we've seen in the wholesale financial markets is probably a slightly different lens to the consumer world, in that in order to commit an offence and to make an attack in the wholesale markets typically would involve breaking through several existing security parameters within a large investment bank, which typically is a harder thing to do than perhaps breaking through to an individual consumer. So it is an active area that our members are currently looking into. It's something which I'm very much aware our members are putting a lot of resources into looking into, but it's not an area that we've directly seen too much, not a huge increase in attacks as a result of Gen AI or Gen AI enabled attacks at this stage. What I would say, however, is that that's not to say that the industry is complacent, because it's very clear that this is an area which could be a risk to the sector. And another area which is also being investigated is around to what extent the new AI models themselves could be compromised by bad threat actors. So we're not just talking about somebody using Gen AI and creating a deep fake profile of themselves in order to fool a system, but actually to what extent can the system themselves be fooled. And there's a lot of work going into that, both from the LLM manufacturers around guardrails and so on, as well as research being done within academia and within firms to understand the models and to understand how we can ensure that the data within the model is ring-fenced such that a bad actor is not able to exploit the models themselves and gain access to information that they shouldn't be doing.
Okay, so cyber risk, is that AI arguably neutral, because while the risk goes up, so does the technology to mitigate against the risk. But the issue we've got is the investment going in at the same level to risk-creating technologies as it is to risk-protecting, mitigating technologies. And are you confident then in your sector that the technology and the skills in the risk protection side of the development is happening?
Absolutely, yeah. So without question,
Ms. Mackintosh is nodding.
Yeah, without question, it's something that firms are looking at very, very actively.
Yeah.
Okay. Just ask before I bring Mr. Dean in. It seems like a bit of an arms race here. You know, you've got the hackers trying to using their AI, generative AI, to get into the system. You've got your system trying to stop it effectively. I mean, isn't there a risk that you could lose that arms race?
It's not a new risk. I think that is a risk that we face into every day. Again, the introduction of AI may bring with it speed or kind of like slightly kind of like new risks to consider. But ultimately, that's an arms race that I think we have had for a while.
You're going to win it.
Yes.
Well, you have to sit there and tell us that, I suppose. So this is partly why we're looking at this, because it's got a lot of alarming aspects to it, as well as a lot of benefits. Mr. Dean.
Thank you. The discussion before actually takes my mind back to a discussion we were having in the FCA last week. And one of the things they highlighted was the sort of lack of cooperation from some of the tech giants, Meta in particular, they were talking about. And it takes me back a bit further in our discussion today about third-party providers. And I know you've said there's nothing new about having critical third-party providers, but I guess most of the time they were probably ones that were within the regulatory reach of government and international cooperation. We've now got tech companies that are so big and so powerful that they don't necessarily have to be that responsive to government demands. And if you look at their kind of ruthless acquisition strategies, are you concerned at all, and perhaps this is a question for you first of all, Jana Mackintosh, from a sort of British industry perspective, are you concerned at all about the concentration of these technologies in a handful of companies and their sort of resistance to comply with regulation?
Well, there are two things I would say. I think firstly, having greater involvement of the tech companies and the service media platforms across financial services for us to kind of manage risk, improve fraud detection, protect our customers is absolutely essential. We have been talking about that for quite some time. I think as you move into greater digitalisation, greater digital access, greater digital use of payments and finance, the role that firms play, that supply and kind of are part of that value chain as we evolve is essential. So I think there's always more that we can do to kind of make sure that they can be held accountable and can comply with kind of the risk that they or the regulations that can manage the risk that they introduce. So I think I'll firstly kind of say that. But I think in terms of concentration risk, a lot of the kind of AI models are open source. And the way that they are deployed, which means that firms can kind of use those and deploy them within their closed environments. Many of the kind of like different deployments and kind of type of models out there kind of allow firms to kind of then enhance and own those on their own kind of platforms. So you can kind of like in part kind of mitigate the risk because of the open source nature of the technology. When it comes to kind of critical mass adoption that you'll see, scalability of some of the models and so forth, the way that you manage your kind of critical third parties will become increasingly important. So I think that will have to evolve as we kind of like see greater adoption of AI.
No, except that's where the technology is now. I guess that's why I mentioned the kind of ruthless acquisition strategies, because we're not just talking about social media. You know, the likes of Alphabet and Meta and Apple, they're all going to want to buy whatever they anticipate is going to be the best technology in this field. And I guess that I'm just wondering if that's a specific worry of yours, or if you think that's just a normal worry that you've always had.
I think, again, kind of it's probably a normal worry. I think the way that kind of big tech and other kind of technology firms kind of participate across financial services bring the same considerations and risks.
Anybody want to have a comment?
Yeah, no, I think the concentration risk issue is not putting words into the PRA's mouth in terms of why they do stuff, but I think that's the very reason why we have the critical third parties designation regime. So you're able to identify these third parties that are critical, where there is a significant amount of concentration, where they wield quite a bit of power, and sort of bring them under the purview of the regulators in terms of how they operate. I think that's really, really important. That's what the whole designation was about. Fundamentally, for me, if I was an insurer and I was looking to, I don't know, take an AI system from someone, part of my own due diligence would be about making sure there isn't a significant concentration there where if that party fell, I'm in trouble myself. So there's an element of safety from regulation. There's also an element of safety from, the processes and steps insurers themselves take before they make decisions about outsourcing or doing business with third parties.
Thank you.
If I may add on to that as well. Sorry. But so in terms of, I guess there's probably two parts of that. Firstly, from the wholesale markets perspective, is that we have very strict processes which govern how we can deploy AI. So there's usually an AI risk committee which would meet to discuss any kind of proposed use of AI. And the concentration risk and the vendor risk is an element which goes into that conversation. And what that means is that every proposal does not necessarily get approved by that committee if it is deemed to be inappropriate or deficient in one of those areas. So what that means is that the model that you described there may not be used in a critical activity because of risks such as those. They may get used in a more peripheral activity where if the connection to one vendor goes down or if that one vendor gets compromised, it doesn't affect a critical part of the business. So the choice of vendor for a particular use case is a key decision in that assessment process. And then again, to echo Ms. Mackintosh's point earlier on, there is an element of dilution of that concentration, without trying to use the words inappropriate there. In that, yes, there is an element of open source models. That changes things to some extent. But also we're seeing a decrease in the cost of producing these models, which means that there'll be more models which are being produced. There's certainly analysis which is being done in academia around using small language models rather than large language models, again, which increases the number of models which are available to choose from. And again, they're increasingly open source models which are now approaching almost on par in terms of quality and output as the more commercial offerings. So when you add them all together, you already have a dilution effect. And then the last element of that on top of it is the use of AI is not just dependent on the model itself. It is also dependent on how a firm chooses to use that model. And that means you're taking the firm's data and putting it into that model, performing some kind of analysis and getting an output. So the firm's data which goes in is a factor, and the processes that you're using it for also become a factor. So as a result, there's a natural dilution. So firm A and firm B could be using the exact same model, but for different things with different data and have different outputs. So from a concentration risk point of view, that is a dilution again. But that's not to say that this is not a risk, again, that we should actively not keep an eye on, because it's certainly an area which is of concern to our members, and we don't want to end up in a situation where we kind of sleepwalk into a situation where we're affecting financial stability because everyone makes assumptions.
Thank you very much indeed.
Just very quickly on that point, is there a scenario where firms might buy technology in order to not use it, and so that nobody else can use it? Things like some of the models that are advancing at the moment, like you talked about the open source models. I'm not sure they'll be up for sale in the same way. Just wondered what your sort of speculation was on that for your sector.
In terms of whether our members could consider buying technology so that...
There's a sort of advances that it's happening so quickly, market, whether you'd buy it out in order so that nobody could use it if it was going to undermine stability or the whole model.
And I guess that probably delves into more the kind of the commercial strategies of members, and that probably exists in every aspect of their business. Whether a firm would choose to buy out an AI vendor just to take it off the market, I guess that's difficult for me to comment. It would be a commercial decision.
I do think it'll be difficult in this instance, given that you've got so many different models and there's kind of emerging models and greater competition around here. I think it would be very difficult to actually make that strategy be effective.
Thank you. Yuan Yang MP.
Thank you, Chair. I'd like to ask the panel about the interaction between AI and consumers, and in particular, I'm thinking about the impact on consumers of AI being used in ways that inform the decision to grant certain services or the price and conditions at which those services are granted. And the spectre of bias. We've had submissions to the committee from those who argue that, in fact, AI can be a tool for correcting and checking human biases, since we know that humans, of course, are also biased. We've also had many submissions from those who've done research into the ways in which AI can introduce biases that are more difficult to inspect because of the opacity, the black box that a previous colleague mentioned, of the AI models underlying them. First, I'd just like to hear from each of you about the conversations that that your members have had between each other and with your associations, and what are the main concerns that they've raised when it comes to the introduction of bias through AI. I'll start with Mr. Otudeko.
I think it's something my members are certainly aware of in terms of the ability of AI to sort of amplify bias, and that again points to the importance of actually ensuring that the data set on which the AI is making decisions on is as complete and accurate, etc., as you can possibly get it. I go back to something I said earlier around regulation, and I think it's important to AI, if it's integrated into an insurer's business model, means holistically you have to comply with consumer duty. So it's not that, okay, I'm not using AI and as a result, I have to comply with consumer duty, but then I'm using it. If it's built into your business model, you have to comply with it, and that includes the outputs and the decisions you make as a result of using AI. So it's not distinct from other elements of the decision making and how an insurer makes decisions on price, value, etc., etc., etc. And as we know, it's the point around the price of insurance products, etc., is driven by quite a few other things aside from the use of AI, even though, you think about the fact that with the introduction of AI, could that have an impact on policies long term? But I think to consider that kind of question, you think about how costly the amount of capital expenditure you need to put up to actually purchase AI in the first place, and then you need to think about the impacts it will have on the individual elements in the insurance life cycle before we even begin to think about, I suppose, the impacts it can have on price. But fundamentally, if it's integrated into a business model, you have to comply with consumer duty, which means that your outcomes have to be those that benefit customers and actually do them no harm.
Thank you. And Ms. Mackintosh.
Thank you. Biases, I think Mr. Otudeko kind of covered it, but I think all the checks and balances will be essential in making sure that as the technology evolves and there's a greater reliance and a use of it across the board, that it doesn't kind of create a singular kind of behaviour in the market. We still need to kind of challenge the data and the outputs in the way that we kind of talked about it before. Because as we kind of like rely on these models and the models train more on the data, there is a risk that kind of like those biases would kind of be amplified in a way, but also kind of like, create reliance kind of like on the AI to kind of help us spot that when we kind of need to make sure that we still have human oversight on the output being created. Within financial services, we are incredibly consumer focused, customer focused in terms of the products and services that we do provide. It is a very competitive market, and so you do need to get it right. The one thing that you never want to undermine is the trust of your customers when it comes to managing their money and keeping them safe and making them feel safe. And the moment you lose that trust, it is virtually impossible for you to kind of regain. So I think there's a lot of caution and care that firms do take if they deploy new technologies and the way that consumers will perceive it, or the way that it will affect the relationship that they have with their customers. You can kind of like work through all the benefits that kind of come with that for consumers in terms of kind of, again, kind of the personalisation of services, greater access to potential services that they might otherwise not have had as vulnerable customers or otherwise, and improve potential kind of like financial inclusion across the board. So you don't want to kind of allow the risks to limit the kind of benefits that we can make sure society and kind of customers can receive, but again, kind of like making sure that we retain that trust. The other thing that I'll say about the technology is that like a lot of this being deployed across financial services, whether it is AI, whether it's quantum, whether it's open banking, whether it's kind of some of the new forms of money programmability for consumers, a lot of this happens behind the scenes. These are technologies that kind of like help improve operational activities or product offerings. Consumers want to see good outcomes. They want to see a product that serves their need. They want to see a product that is competitive. They want to see a product that can be able to address whatever need that they have. And I think that's where we sometimes need to get back to when we talk about the interaction of the technologies with consumers. Deploying these technologies, you do that for a reason, and that reason is in financial services, making sure that you can provide a better product to your customers.
Thank you, Ms. Mackintosh. Could you speak directly to the conversations that your members are having about the risks of bias in AI? What kinds of concerns are they raising?
I think all the kind of ones that that we have kind of mentioned, it is kind of front of mind. It's a risk that is very well recognised, and so within all the kind of processes, procedures, risk management that we kind of deploy, managing those biases, making sure that you can kind of deploy further testing, quality assurance on the output. I think all of those are kind of like risk mitigants that will help you address the biases.
Thank you. And finally, Mr. Luther.
Sure. I think from wholesale markets perspective, there are use cases that AI is suited to and those that are not. So when it comes to bias and hallucination, those are active concerns that we would have. Again, referring to the process I mentioned earlier around assessing any use case for deployment within one of our member firms. That is an area which would be considered. And where we have situations where hallucination may be a concern, it's unlikely to be kind of approved for use in that scenario. When it comes to bias is slightly different in that bias can take forms of the underlying model, how the model being trained, the data which goes into that model, but also factors into how you're going to be using that data. And when it comes to a wholesale market, certainly from a trading point of view, biased data tends to reveal bad trading algorithms. Right? So if you want to be trading, you can't kid yourself by feeding in bad data into your model such that it trades in a certain way. It probably would not behave in the way that you'd want it to behave anyway. So biased data and data selection more generally is an active area that members are very careful, even pre-AI, pre-Gen AI, when it comes to using any kind of model or training any kind of models to perform any function within the wholesale market specifically.
Thank you very much. And as Ms. Mackintosh mentioned, there is a behind-the-scenes nature of these new models. One of the concerns that academics expressed in their feedback to us was the transparency of these models. And I think in particular of a 2019 case from the Dutch Tax Collection Authority, which was a huge scandal about the use of AI in trying to detect fraud. It was a scandal that had been going on for about 6 years before it was then published and detected by journalists, and it had led to objectively a huge amount of bias in terms of accusing families with certain protected characteristics of fraud when in fact many of them were innocent. It led to suicides, it led to families breaking up, etc. And that there was a 6-year gap between the start of that model being applied and it actually being revealed to the public. Now, banks and under the current regulatory regime have to make many things transparent confidentially to regulators. Is there the need for an increased level of transparency given the increased level of opacity of these models? And if so, what kinds of transparency and data sharing do you think would help customers and regulators feel confident in these new models? I'll start with Mr. Otudeko again.
Thank you. So I was thinking about the level of public disclosures insurers have to undertake as a given. There's a document called a Solvency and Financial Conditions Report that insurers have to produce, and it's typically on their websites where they talk about their business models, they talk about capital levels, etc., etc. If I was adopting AI and it was going to materially change how I did business compared to before, I would put that in my SFCR, which is something that would be available to policyholders to read and to understand how I planned to adopt AI going forward. Now, I'm not a tech expert by any stretch of the imagination. I struggle to upgrade my iOS on my iPhone half the time, but I am aware that there are models out there that actually are you can use to explain the outputs and how AI makes decisions and how it comes to conclusions, etc. So it's clearly, again, a question of risk management for me. There's a question of disclosure, and I think there is an opportunity and a means by which you can do that via some of the public disclosures insurers have to undertake. But there is also a question of, as I say, just proper risk management around, being able to explain how the model reached the conclusion. I know as part of the Financial Conduct Authority's sprint recently on AI, there was a bit of discussion about how you keep the consumer in the loop when insurers are taking on AI. It's an ongoing discussion, and it's clearly a valid one where we need to reach a sensible conclusion in terms of how we bring the consumers along with us on the journey as we adopt AI and innovate from a technology perspective.
When it's, as in most cases, difficult for a human to explain how a model arrived at the output that it has arrived at, in those cases, do you see an argument for sharing the underlying data, the underlying model itself, and even source code with regulators? Mr. Otudeko?
I mean, I'm pretty sure you would that the regulator would ask for it. So you would almost, of a necessity, have to share that with the regulator. So yes, I mean, if I was a chief risk officer in a firm and something was going wrong, I mean, it's a fundamental rule for how you engage with your regulators to tell them everything you'd reasonably expect them to know. And if I was using AI in a major way, I'd expect as a regulator to know that. So I would share that proactively.
But even before things start to go wrong, would you expect to kind of declare your model, declare your data?
Yeah, I think you'd have to. Yeah. I think you'd have to. Whilst the regulators are technology agnostic and won't favour you taking one sort of technology over another, again, if you're using something in a transformational way that impacts your business model, you would have to explain that to the regulators.
Yeah. Just to be brief, is there any disagreement on the panel with that view, Ms. Mackintosh and Mr. Luther?
I wouldn't disagree, but I'll also clarify that at this point that's already actively happening today. So I've personally been involved in a situation where the regulator has walked in and asked the bank to explain how a certain model worked. And in that situation, you literally are opening up the source code. And an independent third party is also engaged. And an independent third party, it's their job to literally read line by line, sitting next to the engineer and going line by line through the code to understand how it works. So the regulator has that power today to ask firms to be completely transparent about how any aspect of the business operates.
The models today, it seems, is in response to something happening, something triggering that alert for that particular firm, the regulator goes in and looks. I was wondering if you see a move to a declare first, pre-warning system where the regulator has much larger control and, well, not control, but kind of awareness of the models being used, as opposed to the current, problem-solving approach to going in after an issue is detected.
Again, in the wholesale markets perspective, if I go back to like the MiFID II regulation that I mentioned earlier, part of that involves a compulsory annual audit of your algo trading platform, and that has to be performed by an independent audit function. So that is already in place today, certainly in the wholesale market. You have to perform that function, and you have to be able to evidence that you perform that function. And that function, again, is not just involved with one party, but it's a multidisciplinary audit, which is done on a compulsory basis.
Thank you.
Thank you very much. Harriet Baldwin, MP.
Thank you, Chair. And really, I think these probably are from Ms. Mackintosh again. This committee has always thought that our constituents struggle to get financial advice, and I put the emphasis on advice, without paying quite a high price for a sort of full personalised piece of work. And so probably over 90% of our constituents have to rely on guidance. And I just wondered if your members see a scope for artificial intelligence to bring down the cost, or potentially have a sort of artificial intelligence version of a financial advisor that would be able to help more of our constituents at an affordable price point.
And short, yes. I think personalisation is one of the benefits that you can see from the deployment of the technology, whereas before it may very well have been quite resource intensive or take very long, or kind of can only be done by certain specialists. I think the careful and appropriate introduction of AI into some of those use cases can certainly enhance personalisation.
Are any of your members planning to do that? Yes, now that the regulator is looking at sort of innovation in this area?
It's certainly kind of like one of the kind of key benefits and outcomes they exploring across a number of the different use cases they're looking at.
Can anyone else elaborate on anything they've heard of in this area where artificial intelligence actually helps our constituents make wiser financial decisions?
Mr. Otudeko.
I think, as Ms. Mackintosh just touched on, the applicability of AI and the benefits it can offer there is clear. For me, it needs to be complemented by appropriate regulatory changes. So the work the FCA is doing around the advice and guidance boundary review, I think, is really, really important to make sure that those that are currently unable to get that kind of support and advice are able to take advantage of it. And I see, AI sort of helping helping that process. It's something that I definitely think can be applied there, but it has to be coupled with regulatory changes that make it possible to actually get advice that isn't, financial advice in the typical sense of it.
Anything to add, Mr. Luther?
Yeah, I think on the wholesale side, obviously the consumer side I'll leave to Jana and David, but on the wholesale market side, it's a different kettle of fish when it comes to advising our customers. Typically the conversations tend to be much more bespoke in nature and end up being difficult to automate. But what we have found is that there are uses of AI in informing staff to have those conversations.
Okay.
So there are some of our member firms are using AI to do things such as summarize previous interactions of a salesperson with a client or previous conversations that may have been had around that area. And that enables the salesperson to then have a much higher quality conversation with the client to ensure that we can better kind of satisfy their needs. But we're not at the stage again with the technology where we feel that where as a sector we'd feel comfortable deploying that fully autonomously to have a conversation directly with one of the corporate clients.
Interesting. Thank you, Chair.
Thank you very much, Dame Harriet. Bobby Dean MP.
Just following up on Dame Harriet Baldwin's point there, I was part of a roundtable with lots of fintech firms the other day, and they're quite excited about the potential to offer personalised advice in an affordable way. But one of their concerns was actually that some of the larger institutions in the sector are sort of pressing the go slow button because actually they're quite intimidated by these challenger brands emerging and want the opportunity to be able to catch up. And I sort of heard in your answer, Jana Mackintosh, about how you feel like we need to go at sort of careful and appropriate pace. Is this something you're aware of? Do you think they've got a fair case when they're saying that the larger institutions are slowing down the challenger brands in the fintech sector?
I'm not entirely sure that kind of is a fair characterisation of the behaviour that you see from the larger financial institutions, as we've talked about today. Within financial services and banking in particular, kind of more broadly, there's a very strong compliance culture, a very strong focus on risk management, and a very strong focus on the customer outcomes, and the introduction of something like that will have a direct impact on the outcomes your customers will see, expect and perceive, will affect the relationship that they have with them from a financial services point of view. And back to the point about trust, the moment you break that trust, the moment you explore something that kind of like will make your customers feel uneasy, will be of concern to them. So introducing any kind of risks through that, I think there's caution that kind of like that needs to be taken in terms of how those are introduced. It's not necessarily that's being held back because of competitive pressures. It's more, I'd say, being held back. Linking back to the conversation that we're having around introducing it in the right way, understanding the risks, and kind of like.
I could just challenge slightly. I feel like much of our discussion so far today, the response from the panel in general has been we're actually coping well with the emergence of new technology. Most of it's not new. The regulation's there. We're adapting. We're moving with the times. Yeah. But when we've come to this conversation specifically, and it seems like most of the benefit is going to be to sort of a new set of companies. We need to be really cautious, we need to be careful, we make sure that we don't harm the consumers as we go forward with it. Can you understand why that might be confusing to the panel?
I can see why you would kind of challenge that kind of perception. I don't see it as kind of like contradicting kind of previous conversations. A lot of the introduction of the technology and financial services happen through partnerships. In many ways, the smaller firms, the fintech firms, I think it's a conversation we had earlier, can develop the technology a lot faster. They are more nimble. They've got kind of like kind of the newer platforms and technologies to kind of work on. The larger financial institutions have the resources and the capabilities and the risk management and the regulatory kind of like culture, and those two things need to complement each other in the right way. And I think that complement happens. We do see it happening. There are great partnerships where firms do kind of like come together and kind of provide those. But I also kind of think that kind of fintechs, big techs, kind of non-traditionally kind of like regulated financial institutions do have a different culture, they do have a different risk appetite. And I think for you to be able to marry those up in a way that is responsible, that is measured, needs to be considered in the right way.
Thanks. I'm going to move on now to some of the concerns around privacy. And there seems to be a bit of confusion out in the industry about how much GDPR and Consumer Duty and the Equality Act is actually interacting with AI versus is not a problem at all. We've read that in some of the reports. So Luther, maybe we can come to you first. What is your impression on GDPR, Consumer Duty Equality Act interaction with privacy concerns that might emerge from AI?
So again, that sounds like a broken record on this. It is again a very key part of the appraisal process for any use of AI. Right? So I mentioned earlier about surveillance, for example. So any use of AI for surveillance would have to go through a privacy assessment from the firm to ensure that the data being collected is appropriate and is only used for the use that is intended. So it's not possible for a firm to get away from obligation under GDPR because they just kind of feel like doing a different activity. So privacy is front and center, and it's something that the firms can't really avoid complying with.
Do you think existing legislation is holding back the adoption of certain uses of this technology, from your impression so far?
Interesting question. If it's holding it back, I think it's fair to say that any element of regulation does slow down innovation. I think that's a broad statement which is applicable. The question is whether the regulation is appropriate, and are we happy with the fact that we're slowing down innovation for this particular reason? And I think our members' view would be, when we're talking about privacy, that is a very important element that we shouldn't just consider to step aside from or just ride roughshod over. So I think it is fair to say that privacy regulation probably is slowing down the adoption of AI to some extent, as it is technology in general. But I think the question really should be whether we feel that that's the right thing to do, and our members' view would be it is, because when we come to managing our clients' assets and our clients' money, it's a very serious obligation. So ensuring that things are done in a compliant manner to ensure that data is kept secure, private data is only collected where it needs to be and is used in the use that it needs to be used, and that use only, that is something which would be very critical to our operation.
And then to you, Mr. Otudeko, I mean, the scope for this in the insurance industry is quite huge. I mean, we've read stuff about how you could tailor insurance policies down to areas that have more 20-mile-per-hour roads, for instance, if you had access to that data, and all kinds of other characteristics based on customers. Do you feel like the existing regulations are holding back potential innovations in the insurance sector, potentially being able to lower premiums for people if you was able to be more specific?
No, and I say that because I'm actually a fan, as I mentioned earlier, of the almost technology agnostic approaches that the regulators are taking to AI and innovation more broadly. I think for me the crucial thing is one about proportionality, and are they actually covering the right areas, and also making sure that we understand what the requirements are, because they are a little bit fragmented. So you have things like the SMNCR coming from the Prudential and Financial Conduct Authority, you have GDPR things coming out of the ICO, etc. It's almost making sure that insurers and adopters of AI understand the regulatory requirements across the piece. So I wouldn't say regulation is hindering that innovation currently, no.
And to take a specific example, do you think that insurance companies, health insurance companies, for example, should be able to see things like your Apple Health data on your phone in a safe, secure, anonymised way, perhaps? But should they be able to tailor insurance policies down to like that kind of personalised level of data?
I mean, again, under GDPR, there are strict requirements in terms of access, people being able to give the insurer access and actually consenting to that data being used.
It'd have to be explicit permission for you, think?
Yes.
So if there was a technology developed that allowed you to do that at scale, you think that would be a step too far?
For me, I'd say, I wear one of these devices, right? So I'd want to consent to someone using my personal data, health data, for anything else. I mean, we also need to look at the opportunities here, right? Because again, using my personal device, if you see me doing a few more steps than people exiting the room traditionally should, is because I'm trying to hit my 10,000 steps, and that's because I'm aware of the health benefits of movement. So again, there's the element of the behavior change for the insured in terms of their own personal risk. risks that we need to look at in terms of the opportunity, this wearable technology, etc., provides as well. But again, I go back to the protections under GDPR in terms of the data that's being used, the amount of security around that data that needs to be commensurate with the sensitivity of that data, and various requirements there. And I know the FCA is also doing a bit of work with industry to make sure we understand what the requirements are of us as we use data and of regulation, etc. So I think there's a lot of activity around that question. But again, fundamentally, I like the fact that the regulators are taking a technology neutral, agnostic approach to AI and innovation in the sector.
Yeah. So just a final comparison, I suppose, in the car insurance industry, you could have a black box fitted to your car, and obviously the person consents to that, and that ends up often lowering their premiums. If we were able to develop similar schemes in other areas of insurance, again like health insurance, I don't know, maybe you have to make sure that you take 10,000 steps a day to keep your insurance premiums low. Is that a world of technology that you would be comfortable with, providing there was consent?
I mean, I touched on this a little bit earlier. I think that there are a lot of things that impact, the price and the premium paid for an insurance product, and a lot of that, transcend technology. Again, they're purely from an economic standpoint, the cost at which I procure said technology is an important determinant in terms of how I service the products and how I offer the products to the customer. And currently, my understanding is those technologies are still quite expensive. And again, you need to use them in a substantial way across the insurance life cycle to, reduce the cost of servicing an individual policy before you even start to consider, the implications on premiums. And then fundamentally, even if all the stars align and you get to that place, it will be a decision for an insurer to make. So whilst not speaking for the sector, what I can say is if the opportunity presented itself, especially in the environment we find ourselves in, why wouldn't I, try to reduce?
Maybe in the future. Okay. Brilliant.
Yeah, maybe in the future is a way to put that, yeah.
If I may add a little bit onto that. So the point earlier on, does the regulation hinder the innovation? The question there is, it may slow things down. There are additional hoops that you have to jump through. You're still not prohibited entirely from engaging in a course of action, but there are hoops that you need to jump through to ensure that you satisfy certain regulations. So some of the scenarios that you described earlier on, without going to nuances of them, there may not be prohibited activities in the current regulation, but in order to execute them, you would need to ensure that you collect the data in the right way and used it in the right way.
And if I may add, as the Bank of England survey kind of highlighted as well, one of the considerations, especially for smaller firms and kind of thinking about deploying or kind of developing some of the technology, is around the cost of that compliance, which effectively ultimately impact on your business model and the commerciality of the investment that you do want to make. So that's another thing to consider in thinking about this. But I mean, we have many active conversations with the ICO and the FCA around how to evolve the guidance, which comes back to your question on regulation as well. Although we kind of feel like the financial services regulation is fit for purpose to deploy the technology, we also recognise that there will be areas where guidance needs to be developed, and this is certainly one area where we are looking at it.
Thank you very much. So some quick fire from me, really, because we've touched quite a bit on regulation, but I'm interested to know if you think that any change is needed in the way that AI is regulated in your sector. So let me start with Mr. Luther and work across.
I think from our perspective, from our members' perspective, the regulation themselves, I think we've covered, are generally fit for purpose. What we have found, or our members have found, is that when it comes to some of the larger global banks, there's kind of a patchwork of regulation in different global jurisdictions. So to what extent the UK is able to engage in those conversations to either create some kind of harmonized approach or declare equivalence to certain financial regulations, that certainly would be helpful. If you take the example of huge regulation, the EU AI Act, which is currently in the process of being implemented, that is a horizontal regulation and applies just as much to a global bank with a significant governance infrastructure in place as it does to a tech provider who's using this stuff for the first time. So to the extent to which the government can engage in these conversations and to try and create that more stable and level playing field, I think that would be an approach which would be welcomed by our members.
Mackintosh, anything you think should change?
Well, certainly again agree that we think the financial services regulations are fit for purpose. I think we have a strong framework to deploy the technology in a responsible manner. So we do support the kind of pro-innovation approach. Again, across the board with government and with Treasury and with regulators, we are having an active conversation around the balance between governance and innovation, or regulation and innovation when it comes to managing risk. And I think striking the right balance is absolutely essential to kind of make sure that the benefits can result in a competitive environment, competitiveness, growth, productivity that we talked about before. So again, we are kind of like very actively engaged in kind of making sure that we can kind of develop a regulatory framework that can kind of support that kind of innovation in the right way.
Striking the right balance is an easy thing to say, but quite hard to deliver. And you mentioned earlier, you talked about using AI to understand customers, and it may have been, forgive me, it may have been Miss Luther who talked about how firms use this and then the two ways that this can happen: how firms use it, but also how and what data firms put into this. So there are all areas that are potentially ripe for regulation, and there's all sorts of debate over many years in this place and elsewhere about use of data. We've just touched on it then. So where have you got any view about where the balance should be?
Yes, that is obviously something that you need to kind of like keep considering. I don't think it's a once done conversation that you can have, and kind of choosing that balance. I think it needs to adjust, it needs to evolve.
Once the horse is bolted, that's it. So if firms start using certain personal data or using that data to understand customers and therefore perhaps pitch products to them in different ways, or change their insurance profile, or use their credit information differently, you can't really pull back once it's out there, can you? So do the regulators need to do anything different to stop anything bad happening? What it does?
Well, I think the one thing that we are doing, which we certainly see in other jurisdictions as well, is very close collaboration. I think it needs to be a very close relationship between the regulators and industry, so that we are all informed, we understand the evolution, we understand the risks, and we're not waiting for it to kind of crystallise or realise, we're actively mitigating those. So the collaborative structures that we see around the consortium, the bank is setting up, the testing environment, the FCA is setting up, all of those I think are really good initiatives to make sure that we do this kind of like in lockstep.
It's interesting because if you take a parallel model, perhaps, but HMRC now requires, if you're trying to sell a tax avoidance product, they get in early and make everybody pay up front the tax they might have to pay beforehand. But they're trying to get ahead of the curve because of the problems that have been had with the marketing of tax avoidance products. Do you think there's anything that the regulator should do to try and get ahead, or is it even possible in such a fast-moving area of technology?
Well, I think it kind of comes back to kind of the opening discussion we had about kind of regulation, kind of saying that the financial services regulation is fit for purpose. We do have those regulations already in place. I don't think there are gaps or absences thereof that are of concern to anyone, and that's certainly the kind of current kind of position and kind of understanding of the application thereof. But there will be areas where greater guidance, greater kind of regulatory kind of involvement is going to be needed in the future as it evolves. But I don't think it is starting from scratch when it comes to kind of the application of this. There are no gaps in regulations that we think is needed to manage those risks adequately across financial services.
Mr. Otudeko.
So I'd agree about the point around interoperability of domestic and international standards. I've talked about model risk management quite a bit in the room, so again that's probably an area for insurers that the regulators might want to look at, and I know is already on their radar. I think the bigger point about regulation, which colleagues touched on, is the opportunity cost, because clearly regulation currently is burdensome, quite expensive to comply with, which is why the government's launched the initiative to try reduce the overall burden of regulation. And the fact is, the cost to comply with regulation could be money that could be deployed for innovation, whether in AI or in other areas of the insurer's business model. I think that's the bigger thing to tackle from.
There's also cost in removing regulation, isn't there? Because
there is.
So you don't want to be swinging backwards and forwards.
You completely have to get the balance right, and the point about stability is a really important one. And just to reference what you were saying earlier about the fact that AI is evolving so quickly means if you had a regulatory regime that tried to keep step with every evolution of AI, you'd have a very unstable regime because it is moving very, very fast. As a result, having something that's principles-based and outcomes-focused is priority for me.
Do the rest of you agree the principles-based rather than very prescriptive regulation? Okay, nods from Mr. Luther and Ms. Mackintosh. Ms. Mackintosh, we touched on this a bit when I mentioned the tax avoidance sort of parallel model, if you like. But in your evidence to us, you were very clear that you weren't in favour of the UK adopting the EU AI Act, and I wondered why that was.
It is a very different model to the one that we are considering in the UK, and as much as it is kind of across the board kind of legislation that is quite prescriptive. I think in kind of thinking about the model that we have here, which is kind of sectoral, and allowing for the AI to be applied in use cases within a regulated sector will allow you the flexibility to kind of manage the innovation and the limitations potentially thereof. The flexibility it gives you as well in terms of kind of being outcomes-based and principles-based means that in a space like this where you do have nascent technology that is evolving quickly, you can keep up and abreast with changes that are necessary to do so. If you introduced legislation like in the EU that kind of sits across the board, we know that takes time to amend, it takes time to evolve, and can kind of in and of itself kind of place constraints in sectors where the same kind of like application of the regulation wouldn't necessarily apply in the same way.
Do you have a problem with this, going back to that tax model I was highlighting, just to be clear, to perhaps people who not everybody follows the EU AI Act, and I have to say I didn't until we were preparing for today. That requires companies to register high-risk AI models. You're against that, just to be clear?
No, I think kind of understanding different levels of risk associated with different use cases is important. As we've talked about before, there are certain use cases that are low risk in which you can kind of like explore.
Yeah, but what about the ones that are high risk? I mean, do you think where there's a high risk model being developed, are you absolutely dead set against that, because that's what the model is in the EU AI Act?
No, the EU AI Act allows you to kind of like identify those as high-risk models and then kind of comply certain kind of mitigants and controls around those. I think it's entirely appropriate for you to kind of know which of the use cases in the models are high risk. So the classification thereof, the potential kind of like treatment or guidance thereof, if they introduce different risks, I think are all appropriate. But the fact that you can apply those high-risk use cases within financial services and within sector-specific regulation and kind of AI adoption is helpful instead of like the way that the EU AI Act is thinking about it across the board.
Okay, so they're doing the model you're saying by the sector, in summary.
We're doing it by sector.
Okay,
yes.
and Mr. Luther, Mr. Otudeko, anything you wanted to add to that? The EU
I think
AI
so the AI Act is an area which our members are actively grappling with at the moment, and again, maybe if I could take a moment to give some context to what the Act is about. So the EU AI Act is a horizontal regulation which applies across the EU. As I mentioned earlier, applies to a bank as much as it would do to a dating app or anything else using AI. It requires firms to classify any model in terms of 4 categories. So either it's prohibited or it's high, medium or low risk. If it's a prohibited activity, you can't use it, full stop. And that's really things around social scoring and behavioral and biometric data collection, things of that nature. When it comes to financial services, the high risk category only at the moment in the current interpretation is only really relevant to areas such as credit assessment, employment screening, and algorithmic trading. So it's a very broad category to just define in that way. But in order to comply with the regulation, firms would be forced to rank all of their algorithms and put them in the relevant category. If you are deemed to be high risk, as you mentioned earlier on, that does require you to register that system in a database, obtain a kind of like a CE mark, if you like, for that algorithm, and a whole bunch of regulations around documentation, record keeping, transparency, etc. While our firms are actively working to comply with that regulation, I think it's fair to say that a principles-based regulation is something which would be more in favour with. It tends to be something which is more technology agnostic and it allows the regulation to scale as technology develops. Now, the problem with risk-based regulation is that as those risks change, as the use cases change, the regulation does need to be updated. So that becomes the challenge. The last point there would be around, again, as financial services, as we've talked at length about today already, there's significant governance already in place. So the interaction between a horizontal regulation, which is very broad, and the very deep sectoral regulation that's already in place is causing challenges. So that's an area which you're actively looking to work with.
It's interesting, and the pace at which it's changing makes it hard to change the rules around. I understand that. David Otudeko, anything you wanted to add on the EU AI Act?
So agree with everything that's been said. I think it's important to also remember that within financial services regulators, you have firm-level supervisors who are able to actually take a very firm-specific view as to the risks that firm poses to the regulator's objectives. So we need to, I think it's important not to lose sight of that specificity, coupled with, as you say, sort of principles-based regulation and the utility that could sort of bring to the system.
And then really finally, we've touched on it before. We have the FCA in front of us and other regulators in front of us regularly, but others have commented on the black box. So this is hidden away the detail of it because obviously it's commercially sensitive very often. Do you think the regulators will be able to keep up with looking into that and actually be fit for purpose? Because the best developers of AI, the generative AI, the machine learning, all of the most developed end of it will be moving at a pace and altering at a pace that's going to be quite hard to keep a track of. Do you think that the regulators are up to it, or can be, or if they're not, will they be up to it? I'll start the other way around, Mr. Otudeko.
So, again, going back to Mr. Wood's evidence the other day, I think it's important for them to have the right skills to be able to keep up. And I also think it's important for them to place a level of reliance on the skills within insurers themselves, because when it comes to things like AI, I don't think there really is a monopoly of wisdom. I think it has to be a collaborative effort in terms of trying to mitigate the risks AI poses. So it's about them having the right skills. Are they up to the task? They're extremely clever people within our regulators, so I'd say they definitely are. But they also need to. Well,
they are watching you, Mr. Otudeko.
I'm hoping they are. Makes my next interaction with Sam Woods a damn lot easier. But then, they need to collaborate with the industry and recognise that within industry there is the capacity and capability of actually getting people that have those skills, and it's about collaboration across both. And we've talked about the amount of collaboration going on between industry and the regulators. There is a lot of it. So. Long may that continue.
Jana Mackintosh.
When we talked about kind of skills development earlier as well, around kind of the impact the technology has, I think sometimes we think about the technologies, whether it's AI or quantum or cloud or new forms of money like crypto or CBDCs, that it is just about the technology, but it's not. I think across the board, whether you work in business development or sales, customer management, regulation, governance, board directorships, I think there's a level of kind of training and understanding that we do need to have of kind of like what the technology is, the risks that introduce, and what that means for the specific roles. And the same applies to the regulators. They have a very strong skill set, and I think we are very lucky in the UK to have very strong, capable regulators that engage with us quite frequently and collaboratively. So from a policy point of view and then from a supervisory point of view, from the skills that they have within the regulators, they don't have to be engineers. They don't have to kind of fully understand the models to be able to understand the risks that it'll introduce to kind of like customers and financial services. And I think that's that same level of kind of challenge, education, training that applies to all of us kind of like in the sector will similarly apply to those in the regulators.
I think we touched on this before, Mr. Luther. Anything to add briefly to what you've heard?
Probably just very minor. So I'd echo what my colleagues have said. So there's two elements to this. There's one is keeping the door open to industry and having these conversations. So the session like we're having today, the Bank of England has newly set up the AI Consortium. The FCA set up the FCA AI Lab and the series of events that associated with that. And we've also seen a significant upskilling in the FCA in particular. There's been a lot of hiring of very technical staff into the FCA to help them build out this function. And I think that is the right way to go. So if you want to regulate a function, you've got to have the skills in-house to do that as well. And I think certainly what we've seen in the UK has been a move towards that, both on the open door policy as well as the upskilling internally within the staffing themselves.
Well, thank you. We could go on forever, but we won't. And we are going to be seeing banks in the next couple of weeks, so we've got lots of work to do in this area. I think it's going to be a running theme, I suspect, for the Parliament. But can I thank our witnesses very much indeed. From my left to right, that's Amandeep Luther from AFME, Jana Mackintosh from UK Finance, and David Otudeko from the Association of British Insurers, the ABI. Can I thank you very much indeed. The transcript of this session will be on our website uncorrected in the next couple of days, and we will maybe be producing a report. We're yet to decide what we do with all the evidence that we're receiving. Thank you very much indeed. Order.